Right, so hopefully by now all of you should now be able to find your way around a financial chart. We've just gone over some of the basic chart properties in the previous chapter. We've looked at things such as the open of a bar, the high, the low, the close, the range of a bar. We've also looked at some basic market terminology, terms such as bull, bear, long, short, etc. We're going to put the basics behind us now though, and we're now going to start taking a look at the first market concept that you're going to be using as a trader. The areas we're about to look into, or rather the concepts we're about to look into, are part of an area that's known as technical analysis. Now, despite the technical sounding name, technical analysis is actually a very complicated name for something that is essentially very simple. We use technical analysis as traders to define and determine our trading opportunities. By using it correctly, as I've already explained, we can work out what the market is likely to do next, and obviously if we can do that, then we can make money. Now, trading is common sense and simple. I've told you this over and over again, and I will continue to tell you. Please do not make the mistake of trying to overcomplicate things. That's what the novice traders do, and that's why they fail. Professional traders keep things simple. As traders, we are just looking for the simple, straightforward, basic, obvious chart patterns. And there's a very important reason why we are looking for the most obvious chart patterns. I'm just going to get my pen out now and give you a little example here. Let's imagine that we're at this point in time just here. Let's imagine that a pattern has just formed. It hasn't, this is purely as an example, but let's imagine a pattern has formed just here. And this pattern tells us that the market is likely to move off in that direction. In other words, it's likely to move upwards. If we've spotted that pattern and we arrive at this point in time and the market does indeed start to move upwards, we are obviously going to buy into that move because that's what we expect to happen anyway. We've been monitoring it, we're waiting for it to happen, we expect it to move upwards, it does, so we buy into the move. Now here's the key point. If that pattern is obvious, millions and millions of other traders worldwide will have spotted exactly the same pattern, they will have exactly the same view as you, and therefore they will be buying into the move too. And it doesn't take a genius to realize that that move is going to be quicker, more powerful, faster, and it's just going to generally have a much better chance of success. That is why it is so essential that we are always looking for the most obvious patterns rather than the most complex or hidden patterns. Now, as I've said, novice traders never understand this fact. They would prefer to find a hidden, complex pattern, simply because they believe that if they have found something that most other people have missed, then surely they're more intelligent than everybody else and surely it's going to have a higher chance of working. It just doesn't work like that. You can never outsmart the other traders, and you can certainly never outsmart the market. So keep it simple and always look for the most obvious patterns. All we are trying to do essentially as traders is hitch a ride off of the big major traders. The reason that markets move, in other words, the reason we get movements like this where it moves upwards, is predominantly down to the big traders. So in other words, the hedge fund traders, the banks, the floor traders, these are the people that are plowing billions into the market on a daily basis. Small, tiny, insignificant traders like myself and like you will be do not even make a dent in the daily turnover of a forex market. All we have to do is find out what the big players are doing, find out the patterns that they're looking at, work out what they're doing, and basically hitch a ride on the back of their moves. As I said, they are the people that drive the market, they are the people that cause the market to move. They will actually be, for example, this example here, this example I've just given you, they will also be looking for basic chart patterns. This is only an example, remember, but they will also be looking for things like this. If they can see that the market is going to move upwards, or it has a likelihood to move upwards, they'll be plowing their billion-dollar funds into the market. It starts to move upwards, you just hitch a ride on the back and you make money. That's how it works. So I'm going to say it again because this point is vital. This point alone, in fact, is enough to make you money in the market. You should always be looking for the most obvious chart patterns. The more obvious the patterns are, the higher chance there is that other people have spotted them, and therefore the higher chance there is that that particular move is going to be successful. Right, let's move on to the concept that we're going to be discussing in this section, and that's the concept of trends. One of the most basic trading concepts that you will come across, and actually one of the most important, is the concept of trends and how to correctly identify market trends. Now, technical analysis assumes that prices move in trends, markets move in trends. At any one time, the market is going to be doing one of either three things. It's either going to be moving upwards, downwards, or sideways. It can only ever be doing one of those three things. All we have to do as traders is work out which state the market is in at any one time. As I said, it can only be doing one of those three things, upwards, downwards, or sideways. The reason that it is so important that we identify which state it is currently in is because we want to be in the same direction as the prevailing trend. So let's start from the beginning. A trend is simply a direction. It's either upwards, downwards, or sideways. Now, the reason that we want to be in the direction of a trend is because there is a saying in trading that the trend is your friend, and it's all down to momentum. Now, let's just take a look at this particular trend. On the screen here, you can see that the market is moving upwards. It starts down here and it ends up right up here. So the market is moving upwards. As traders, at this particular point in time, the trades that we would be looking to enter, ideally, would be long trades. In other words, trades where the market is where we're looking for the market to move upwards. Why? Simply because of the momentum. There is clearly more momentum in an upward direction here than there is in a downward direction. The bulls are in control. You can see they're in control because continually the market is moving upwards. That is why the saying, "the trend is your friend," is so very true. What you don't want to be doing is, in this type of trend, you don't want to be opening positions where you're looking for the market to move the opposite way, simply because, as I said, there's no momentum in that direction. All of the momentum is currently upwards, so that ideally is the direction that we want to be opening trades in. That's why it's important to be able to identify the prevailing market trend. Now, there are situations where we'll be looking for the market to come downwards or reverse trend. And for example, let's say that we're at this point in time here now. Let's say that a pattern has arisen here. It hasn't, again, this is just an example, but let's say there's a pattern that indicates that the market is actually far more likely to move downwards now instead of continuing upwards. In that situation, we would obviously look to short the market and hope for the market to come downwards. But again, we would only be doing that if the pattern was obvious enough and there was a high enough chance that there would be millions of other traders worldwide that are thinking the same thing. Anyway, that's by the by. As I said, it's vital to be able to determine which direction the market is currently moving in. If it's moving up, we want to be opening trades in an upward direction, in other words, long trades. If it's moving down, we want to be placing trades where the market is looking to go downwards, in other words, a downward direction. Now, all of this might sound incredibly obvious when I'm explaining it here on screen, but you would be shocked at how many novices get this part wrong. As I said, this is the most basic concept that we need to be aware of as traders. It doesn't get any more basic than this. The first thing we need to do when we open up a chart is identify the prevailing trend. So, how are we going to actually do that? Right, let's clear the screen off. The first thing that we do is simply use our eyes. As I've already explained to you, just by using our eyes on this particular screenshot that we're looking at the moment, we can see that the trend is upward. We don't need to use anything technical. We can see that the market starts down here and it ends up here. Therefore, the market is upwards. Let's have a scroll through and see if there's a change in trend. You can see here again, the market is moving upwards just by using our eyes. Now let's try and find a downtrend to show you. Okay, here we go. Now again, just by using your eyes on the screen, you can see clear as a bell that the trend is downwards. It starts somewhere up here and it ends somewhere down here. The trend is clearly downwards. So that's one of the main ways that we're going to be using to define a trend. We simply use our eyes. Again, keep it simple. We don't need to overcomplicate things. Just use your eyes. If it looks like the trend is downwards, and as you can see on the screen here, the trend is clearly downwards, then we're in a downtrend. If it looks clearly upwards, just like we had over here, then the trend is upwards. However, we are going to use something slightly more technical. There is a way that traders use to define trends. It's quite a common way, and it simply comes down to monitoring the highs and the lows. Now let's just take a look at what I mean by a high and a low. A high point, as the name implies, is a high point, so the market comes up here. Then we come down to a low point, high point, low point, high point, low point, high, low, high, low, high, and so on. The market is continually posting highs and lows. That's all it does. It will either be posting subsequently higher highs and higher lows, or lower lows and lower highs. Let me explain what I mean. If we take a look at the low points here, again there's loads on the screen, I'm just picking some of the major ones here. You can see that each low point is subsequently higher than the previous low point. It's like an upward staircase. You can just see here, look. So that's the concept of higher lows. This low point here is higher than this one. The market goes up, it comes back down, and this low point here is higher than this one, and so on. So that would be, we would be expecting higher lows in an uptrend. We would also be expecting higher highs. So if we mark the highs, you can see that the highs are slowly getting higher too. So each high point is higher. This high point here is higher than this one. This high point here is higher than this one, and so on up the ladder. So you can see again, it's just a slightly more technical way of looking at things, but you can see that the trend is upwards. It's like an upward staircase. Now obviously there are loads of highs and lows here and here that I've missed out, but we're looking for the major highs and lows, and we're just looking, we're trying to keep it basic, and we're just trying to look at things at a glance. So you can see we've got a high, low, high, and so on. We're not trying to pick every single little high and low, because obviously you can see, for example, that high point is actually lower than this high point. But on the whole, the highs are getting higher each and every time. So that's what we would expect during an uptrend. During a downtrend, we would obviously expect the opposite. So there was a downtrend back here, I believe. Yep, this one here. If we do exactly the same thing, take a look at the low points. You can see that the low points are now getting lower each time. Each low point is lower than the previous low point. This one here is lower than this one's lower than this one, and so on, in the form of a downward staircase. The highs should also do the same thing, so if we mark the highs on, the highs are slowly getting lower each time, in exactly the same way that it happens during an uptrend, but obviously the exact opposite. So it's just a downward staircase this time. Each high point is lower than the previous high point. So during a downtrend like we're in now, we will be expecting lower lows and lower highs, and during an uptrend we'll be expecting higher highs and higher lows. That's the way it works. It's just a slightly more technical way of looking at things. What if a market is not moving up and it's not moving downwards? In that particular situation, it is said to be moving sideways. This is a nice example here of a sideways moving market. You can see here there's no particular trend, although it's slightly upwards. You can see this part in the middle here. If we mark the highs and lows here, you can see it's an absolute mess. We've got highs and lows all over the place. Sometimes it goes higher, like here we've got a lower low and this one's lower than this one, but then we've got a high here that's higher than this one, then it goes lower again, then we've got a higher high. In fact, all of these highs are pretty level. And then it comes down here and then we shoot right off up here. So it's just a mess. It's a sideways market. It's almost as if the market is contained in a horizontal rectangle. And when the market is moving sideways, it is said to be ranging, or it is said to be range bound. So when you hear someone talking about a market that's within a range, or a ranging market, or a range bound market, that just means that the market is moving sideways. It's not posting higher lows or lower highs or whatever it is, it's just posting a bit of a mess. I'll try and give you another example. There's a few examples. This is a nice example here again. You can see all over the place. No definitive trend there at all. You just don't know. It's moving in a horizontal box again. It's moving sideways. What do we do in a sideways market? Well, I'm going to be giving you some trade ideas a bit later on, but on the whole, when you find yourself in a ranging market, you go and get your golf clubs, you put them in the back of the car, and you go and have a game of golf. Quite literally, you take the day off. The problem is when you're trading within a range-bound market is that you have no trend to be a friend with. Remember the saying that the trend is your friend? That's very important to remember, and in a sideways market there's no trend to be friends with. It's going all over the place. And that brings us on to another term now, and that's the term of a whipsaw. Now a whipsaw is simply when you open a position, so let's say you're going upwards and immediately you open the position, or very soon afterwards it just reverses on you and goes back the other way and you lose money. That's what's known as a whipsaw, and whipsaws occur frequently in range-bound markets. So you've got a market here that's moving sideways. What would happen is you've got no trend to be your friend, so you enter a position here and it just reverses. You can see it's just like a zigzag, up, down, an absolute nightmare to trade in. When you're trading with a trend, as you can see here, if you're entering long trades, you know that there's a slightly higher probability that you're going to be successful, whereas when you're in a range-bound market, you've got no idea. I mean, here's another example. It's just very messy. It's what we'd call a choppy market. Just as you can see, it's just choppy, up, down, up, down, up, down. Right, so that's pretty much it now for trends. As I said, there's two ways to define a trend. The easiest way is simply to use your eyes. That's what I do most of the time. I open a chart, I take a look, and you can usually see what the trend is. Secondly, you can monitor the highs and the lows. If it's posting, I'll write it up again, if it's posting lower lows and lower highs, the market is moving downwards, and if it's posting higher highs and higher lows, the market's moving upwards. If it's not posting anything at all, it's moving sideways, and those are the markets that we don't really want to be involved in. Right, support and resistance is coming up next. Support and resistance is by far and away the most important concept in the whole course. All of my trading decisions revolve around support and resistance. So it's a very important chapter coming up next, and we're going to be going through it in detail. I'll see you there.